Welcome back to the Seattle Real Estate Podcast. I'm now joined with our good friend Tucker Maxwell and Stephen, the reverse mortgage guru. First off, you guys all know Tucker, but just we do this, it's tradition. How was your weekend? What did you do? Anything fun, Tucker?
I did. I went to Boise, Idaho, and played in a golf tournament with my brothers. My first ever legitimate golf tournament, and we won our flight. So I'm 1-0.
Solid, dude. Congratulations.
Yeah. Thanks.
Umbrella for the weekend. What's that?
I played horrible, but we still won.
So your brother carried you?
He did. It was his course, so that was his job.
That was his job. Yeah, exactly. And Stephen, how about you? What'd you do fun this weekend?
Camping and fishing.
Camping and fishing. Where do you live, Stephen?
I live in Denver, Colorado, so made our way up to some gold medal water fishing grounds there and caught a bunch of big brown trout. So had fun.
Nice. Grill them up over the fire later that day?
Later that evening, yep. So
very nice. I myself went to the Indy 500, which was phenomenal. It's a human spectacle, and the race was delayed for 3.5 hours. Still got the race in, and it was like a burner at the end. It was awesome. It was really cool. So, yeah.
Fair.
All right, let's talk case study, reverse mortgage. And we didn't script this. It's not planned. Tucker and I have been talking about these before, as I believe this is something that the boomers need to pay attention to. And those that are coming up behind the boomers as well. It's an amazing tool. They can put you in a position where you don't have to be financially strapped in your golden years because of your house, because of the thing that you raised your family in. And there have got to be different ways to do that. So we're going to do a case study on what I call a reverse to purchase, right? Is there a technical term for that, Tucker?
Reverse for purchase. You nailed it.
That's what you call it. You guys have some weird acronyms for it, though.
Home equity conversion mortgage, HECM.
HECM. I knew there was something, right? Some acronym. Yeah, home equity conversion mortgage, HECM. Okay, so what we're going to do here is I brought up a house. This is just a home that I found randomly, and it's in Renton. And in Renton, it looks like it was built in '68, and it looks like one owner. That's pretty amazing. And the current home value is, let's just say it's somewhere around 592, and it goes from 520 to 600,000 roughly. My guess, I don't know. I'm just making an assumption is either it's completely remodeled or it may just be in the same state. One owner, it seems like it could even be a rental. But let's just say in this instance, this is a person that's aging in place and they haven't really fixed it up over the last 20, 30 years. They haven't needed to. They're just living there. So the problem is now this home is starting to cause a lot of problems because they're just not utilizing it. The grass is high, it's all that kind of stuff. And they only use the living room and the dining room and the bedroom, and that's it. And in many cases, what I've found is people that are living in multi-level homes where it's even worse, where they go up the stairs from the garage and then it's kitchen, living room, bedroom. That's it. And the rest of the house is chock full of stuff. So in this case, like, the ideal situation would be either a one-bedroom townhome condo with little to no exterior maintenance as a part of an HOA. So how do they get there, right? So the first thing we would do is talk about selling this. Session timeout. We're going to continue session. Anything to add here, Tucker? Anything to add, Stephen? I mean, still in the kind of getting the numbers phase.
Well, yeah, you are absolutely correct. The thought process would be to downsize, and that's what the primary goal is. But with rates where they're at today, there's a lot of folks that are scared to relocate. Maybe they feel they can't afford to get into those communities that are going to achieve those goals that you're saying.
Yeah, and that's right. So I didn't state the problem as clearly. Is what we're finding is people are saying, well, okay, I got to sell this house and then I got to buy something else with that. And I can't buy anything with that. I can't, because after getting this prepped and ready to sell, it's going to be about $550,000 left. And I want to hang on to some of this money. So I'm thinking $300,000, right? So I've got to take $300,000 and put that as a down payment on something and free and clear, right? And okay, great. And then I got to make sure I can afford the property taxes. So I'm going to set aside another $150,000. And then, I'm getting my pension or I'm getting my retirement or I'm getting Medicare. And now I just have just a little bit amount to breathe on. And, my grandkids are down in Southern California. I really can't go see them because I don't have the money for that. But at least I'm no longer in this house that's deteriorating. So, that's kind of the reasoning, right? And the challenge. Anything else to add?
Or just folks that are, let's face it, King County is expensive, right?
Yeah.
Folks that are relocating from out of state into King County, or let's say moving from the eastern side of the state, where it might be a little bit more affordable in some areas, to King County where their kids or grandkids or other folks live.
I always think it's like a quality of life thing too, right?
Quality of life, absolutely. Yeah. This reverse product that we're going to be talking about here is just the means to eliminate obligation of a mortgage payment, minimize your down payment, which is the goal of, or the reason why anyone uses a mortgage, whether it's a reverse or a regular mortgage. The goal is minimize my down payment.
Yeah.
And accomplish the same thing as a all cash purchase, no mortgage payment. So it's really giving you the best of both worlds here.
Yeah. So I like that. Is the idea is we are eliminating all the other challenges that are being faced. Okay. So if we take this home, we're basically, let's just say it's in disarray. So it's not going to get top dollar. Somebody comes in, quick cash, they 560. Your net proceeds are going to be about 500,000. So now you have $500,000 left, and we talked about that before. So you're looking 500 or below, as low as you can. You can't find anything. I just went onto King County, and I said, okay, I want to find. These are all 55 and over communities. So what are all the homes, right? So you've got like a mobile home here for 389. You could kind of do. You've got a condo for 320. So there's, in Glen Acres Drive in Seattle. So there are some options available. But, what I find is when people start looking like that, they're like, well, I can't find what I want, so I'm just going to stay put, right? So now, if I were to go into this reverse loan purchase, Tucker, what did you say that the max loan amount was?
Yeah, so it's going to be based on the applicant's age, but the max loan to value, or the inverse of their down payment, is going to vary based on their age. But at 65, you're in the 30s. Steven, correct me if I'm wrong, 30 to 35%, correct?
Yeah, today's interest rate market has impacted forward loan originators, causing payments to go up. With this reverse mortgage, higher rates means lower loan to values.
Got it.
So yes, today at the age of 62, we're looking at about 35%. But if interest rates were to come back, that number could improve as much as 15% to get us back. In the last 24 months, the direction of the 10-year Treasury has impacted the loan to values by 15%.
So really, essentially, by putting 500 down, and I think what we determined was roughly about a $700,000 purchase amount.
Mm-hmm.
Does that sound right? So now you're moving from a 325. You're moving. Well, if I go, did I go by price minimum? Oh no, newest. Let's go by highest. So now I'm looking at something new in black and in Buckeye and Black Diamond. Excuse me, Buckeye is a different place. Buckeye Avenue, 682, brand new senior living. So what they do in these, it's not senior living. Let me rephrase this. It's a 55 and over adult community. So the maintenance around the outside is going to be all taken care of. And you get all kinds of other options, but these are like new. Of course, you could still go 500,000. If you go 500,000, then you're actually cash to close is, let's do my math here. Oops, I put it over there, 67. So 350,000. So does that sound right? Cash to close 350?
Yeah, probably minimum down payment of 335 plus closing costs. Okay.
So now what you're doing is when they go in and they make this purchase and they put 350,000 down, or what did you say?
335,000.
335,000 minus 500. So they've got another 167,000 that they've set outside of this house purchase. And how much are they paying on a monthly basis to live in this house?
So it'd be taxes, insurance, and HOA. So whatever those total there.
So taxes, insurance, and HOA. Now, is there a way to wrap the taxes, insurance, and HOA into the loan?
There is going to be a way to wrap taxes and insurance in. HOA would always be
Okay.
outside. However, in most cases, people with good credit that are financially savvy that might be considering a move like this would usually take care of the taxes and insurance themselves outside the transaction.
Tell me why that is.
Well, so with the reverse mortgage, payments are not required. So we approach this as if we're not going to receive a consistent monthly payment, which means that we're focused on taxes and insurance for a client's life expectancy. We need to make sure that there's never going to be a point in time where they could ever fall behind on taxes.
Mm-hmm.
So if we come to the arrangement where it's a part of the loan transaction, we have to set aside enough to account for taxes and insurance for whatever that client's life expectancy is.
Got it.
Someone who's 65 might have a life expectancy of 20 years. 20 years times, let's call taxes $5,000 a year. And it can be a pretty hefty set aside.
So it's a set aside that you have to do.
You have to fund a line of credit that can be used only for taxes and insurance.
Okay. So then how, even with our appreciation rates, you can't somehow do something with that?
So there is a growth factor with it. So it's not an exact 20 years life expectancy times your present tax bill. But it can be quite hefty for folks, especially in counties where you find some pretty large county tax bills for properties.
Right. Yeah, definitely. So then if you're looking at something like this, where we are doing this reverse mortgage, essentially because it's cheaper to do it on the outside, what happens when they stop insurance or stop paying taxes? What happens there? How do we solve that piece of the puzzle?
Well, it would really be no different than if the house is free and clear and you stop paying the county tax man.
Mm-hmm.
They're going to come after their money.
Yeah, so that would lead me back to this previous homeowner in this house. He was clearly already paying taxes and insurance. And if I look at his property tax bill, here we go. It is $4,200. So they were already paying that. Now they move it to this other one. It's going to be a higher tax bill if they go with a higher price property. So yeah, and it looks to me like, oh, that's right. Are you familiar with this, Tucker? Right here at a certain age, you get a augmented tax base. So,
yeah, senior exemption.
So you could use that as well in this case. So as a purchaser buying a home, having a senior exemption, now they can actually get a senior exemption on this new home purchase too.
Mm-hmm.
Yeah, and Stephen, if they didn't max out their loan to value, let's say they bring in some of that set aside of 160,000. Let's say they do I don't know, 20% loan to value or something like that, and they also have a line of credit. Won't that line of credit be growing with appreciation that they could tap into to cover some of these bills over time?
That is correct. So the easiest way to approach understanding the reverse mortgage is that it is just a home equity line of credit. At its core, that's all it is. And with a purchase transaction, the total line of credit is being liquidated. You're using 100% of your line of credit towards the purchase price as a means to lower your down payment. But let's just say hypothetically that you qualify for a $200,000 line of credit with the reverse on a $500,000 property. Well, that means your down payment's going to be $300,000 plus the closing fees. Now, in the event that someone decides that they want to come in with not $300,000 but perhaps $400,000 because they have that cash on hand, that means that they're using $100,000 less of the $200,000 that they qualified for. So in that situation, you could do a purchase transaction and start day one with a $100,000 line of credit because you qualified for $200,000 up front and only used $100,000 of it. And then what Tucker's saying here is that the unused portion of that line of credit is growing. It has a growth rate with it. And in our case today, growth rates are around 7.5%. So if you had a $100,000 line of credit at your disposal and you didn't touch it for a year, Now you have 107,000. After 2 years, 114,000, 121,000, continues to compound and grow for you. So it's the reverse mortgage product is now being considered as a financial tool for some folks that understand some of the minutia that we're getting into there.
Wow. So
that should keep up with the property tax increase, Dan, right? Because we know the taxes were 4,500 are there. So even if the tax bill goes up with appreciation, that line of credit is as well. So it should cover that cost.
Yeah, it makes sense to me. I think from a standpoint, let's see, can we get three of us? There we go. From a standpoint of, protecting the senior from a situation where they are going to overextend themselves if they just blow this money, right? You put it there, it's in place, and actually, the escrow, based on this scenario, they're already paying property taxes and insurance. So the HOAs are the one thing that you would have to watch out for. But if you find a home that isn't a part of an HOA that you can use, you're just not going to have that payment. So it really is something that, like, how do we get more people to learn more about this? What's the best way?
I think we just need to talk about it more. I think there's a lot of myths around the whole reverse mortgage concept. And so if we can overcome those myths and really sit down with these boomers and these senior citizens to understand the myths aren't necessarily true. I think, Stephen, you could probably talk to this, is there's a lot of worry that the bank's going to take the home and there's going to be nothing left over. And these people want to pass a little something on to their heirs. And so, Stephen, can you talk to that misconception of the bank taking the home or owning the home?
Absolutely. Yeah, there's a lot of misunderstandings about the product, but the first thing that people need to know is that you need to actually educate yourself on what this loan is today. It's not the same loan that it was 5 years ago, 10 years ago, 15 years ago. It's been around for some time. And the FHA's learned what was wrong about it in the past and have really refined and modified the product to be more conservative. Now, some things that folks don't understand about the reverse mortgage are going to be that you can treat it like a normal loan if you wanted to. It works just like any other loan option out there. You get a monthly statement in the mail. That monthly statement's going to tell you your balance is X, and that's what you would owe back to the bank if you decided to list and sell the house next month. Now, you can also treat a reverse mortgage like a regular loan and make a consistent monthly payment if you wanted to. The benefit of this product is going to be that you're never obligated to a specific payment. You're taking control back of your finances at a point in time or a point in your life where fixed income might not be quite cutting it. So you're taking control back of what your obligations are on a monthly basis on your household.
So it's kind of like treating your home like a bank rather than just a solid asset with equity in it. Now, one thing I would really love to see is let's take John, and right, he bought this house at 65 and he passes at 85. What happens with the house now? Do we have numbers? Can we calculate numbers on does it just go to the bank and then the family, is like, okay, let's clear out dad's place? What happens?
So there's a couple different scenarios that we can roll through there, but the first thing that needs to be understood is that when in doubt, default to what you know about a regular loan, because a regular loan, the kids still inherit the house, and that's no different with the reverse mortgage.
Okay.
The kids have two options when dad passes away. Do I want to keep the house? Do I want to sell the house? And if they plan to keep the home, they call up a guild loan originator like Tucker and refinance the note into their name. They qualify for a particular loan.
Refinance into their name without having to be a senior?
They would have to do just a regular traditional mortgage if they're not of age for a reverse.
Okay.
Or any other mortgage.
You have to live in the home, right? It's primary only for a reverse mortgage.
Yeah, I mean, there are circumstances where the kids want to relocate to the property, and maybe the kids are 62 years old, qualifying age for the reverse mortgage. So in theory, yes, they could they could refi from dad's reverse into their own reverse mortgage, but they'd have to be eligible. The whatever means are to pay off the loan, whether that's other assets that dad had or a mortgage that they qualify for with Guild,
Life
other
insurance, maybe,
life insurance, absolutely. So option A for the estate is I'm going to pay off the loan or I'm going to refinance the loan and keep the home. Option 2 would be just to list and sell the house, pay back the balance, and then take the remaining equity as their inheritance. In my opinion, I think the reverse mortgage is a better fit for the estate. Any guesses why?
Does it avoid probate?
Well, that doesn't avoid probate. It would be no different when it comes to ownership or distributing the assets that a regular loan.
Why?
The main reason why a reverse, in my opinion, would be better fitted for the estate is because just like dad wasn't required to make a monthly payment when he was around, the estate is not met with the financial burden of a monthly payment the day after dad passes.
Right,
if it's a regular loan,
I see what
they
you're saying.
inherit the property, they must make a payment every month until they settle the debt.
How long do they
have? With the reverse mortgage, they have 6 months from the date of dad's passing to decide what I want to do. And then if they're actively pursuing one of the options of listing and selling or refinancing the note, they can get granted extensions to total 1 year to settle the debt.
They work from 6 months to a year to kind of figure out what to do with dad's property, roughly.
And all while payments aren't required.
Oh, that's cool. And that is the
huge.
nice thing about that. Yeah. And I think one thing to consider too is tax implications. And this is a different topic, but there's always a step up adjustment and stuff like that. So like the sooner you do this, the better the tax ramifications could, because let's say if mom and dad are in this house and say mom passes first, that's highly unlikely. It's usually dad. Then there's a step up basis for the estate prior to sell. And versus selling at say 85, a house that they've had since 1960, and it's going to be a freaking hit. I mean, there's a number of different ways to do it. I've even thought about wanting to talk about building an ADU on the back of a house and doing a reverse purchase on the ADU. And I mean, there's some way more nuanced things that we can get into. But from a standpoint of because there's no payment, and let's say I'm guessing you guys have some numbers. The appreciation will be what the appreciation will be. But your increase in, say, the balance has some kind of actuarial number to it based on the interest rate currently. Is that right?
Mm-hmm.
So like if we did, like we said, it's going to be 33%. So they're putting, $400,000 down. I can't remember all the math details, but let's say $400,000 is the loan. The max loan balance was something like that. Was that right? At a $700,000 purchase, 400 and something.
So we'll send it to you, but it's all going to be based upon age. So someone at the age of 62 qualifies today for 35%, meaning the bank can give you 35. You got to bridge the other 65%.
Yeah.
Someone at the age of 80, as an example, qualifies for closer to 50%. So their down payment would be 50%.
Where will it be in 15 years?
So the scenario that I'm looking at over here, we got an 80-year-old client buying a $600,000 house. Down payment's $332. That's the 50% plus the closing fees approximately. And let's say that he's living in the house, not making payments for 10 years. Okay, he's 90 years old. We have to assume what the nationwide average is for property appreciation. This is definitely low for King County, but 4% is about the nationwide average since they started keeping track of it. So house value today is worth $600. 10 years from now, they're projecting, given regular 4% property appreciation, house is worth about $888. Okay. Now that client started with a loan balance of $289. didn't make payments for 10 years, keeping that money in his pocket, improving his quality of life, making sure that he can afford prescriptions, what have you. Not be a burden on the kids is a big deal for this age demographic. That loan balance, travel.
Yeah.
Travel, help with college tuition for grandkids, all those things that they want to do that they're not necessarily able to do.
Mm-hmm.
So 10 years of no payments to accomplish all these things means that the loan balance is basically doubled. It's now 562. Okay. But if the house is worth 888, kids inherit, pay off the 562, they still have 325,000 left over to take with them as their inheritance.
Yeah, and it started as much less than that, and that's with 4% appreciation. So it's the money didn't really go anywhere.
Exactly, and that's the misconception. People think that it dwindles.
Yeah. Well, cool. Stephen, I appreciate this, and I think that we should probably try and do a workshop or seminar or something like that, and invite some people that would qualify to see if this is a good fit for them. I know that's something that is, I think, really needed. So, if you're interested and you're watching this, feel free to give us a call. And here's how you can get a hold of Tucker. It's coming around on the bottom. You can get a hold of Tucker 425-757-9202. Thank you guys very much. I appreciate it. And I think that's the end of our podcast. So I'm just going to conclude. You guys have a great weekend. I appreciate the conversation. Stephen this was a last minute, like, hey, hop on this. He's a true expert. And that I would expect nothing less from Tucker to bring to this table. So thank you so much for coming on.
Yeah, thank you, Dan.
Appreciate it.
Thanks, Stephen.